Hello again, and thanks for tuning in. For those of you who don't know, my name is John Flynn with Flynn Real Estate, serving Southern Ontario, here to give you my professional and honest opinion about the Canadian housing market. I get a lot of questions or a lot of comments about where's the bottom, or how long is it going to take to get to the bottom. So I figured, let me look into this, see what answers I can find. I'm not an economist, I'm just your average Joe real estate agent. But I do keep up on the market, so I've got some information together and I'm going to try to answer that question. What are the price declines going to be like, and how long will they last, or when will the bottom be? So let's check this out. I'm going to start with historical crashes or downturns and look at what happened there and try to compare and see if there's any trends or similarities to them that we can compare to today, and if we can make a prediction based off of that. So let's check it out. So let's start with 2008. So the Great Recession, it was called, in 2008. First of all, there was inflation prior to the 2008 crash. The actual real estate prices peaked in 05 to 06, I'm going to say 2006, and they started to decline prior to 2007 and 2008. The financial crisis was the stocks. That was a result of the housing market and other things. But actually prices peaked in 2006 and they bottomed out in about approximately 2012. So 6-7 years approximately of price declines from the peak. Prior to that, they had low interest rates. The Fed hiked rates 17 times from June 2004 to June 2006, and they went from 1% to 5.25%, and that's the federal rate. Of course, mortgage rates got affected by that. Of course, one of the major issues was subprime lending, where people started off with a very low rate and ended up with a higher rate and couldn't maintain it. And that was a combination of the subprime lending practices and, of course, the interest rate hikes. Here's a graph of the federal funds rate prior to the 2008 crash, and you can see where they hiked the rate 17 times. They hiked it from 04 to 06 very aggressively. That lasted a year or so, and then of course they dropped it back down to record lows to stimulate the economy, but that was too late after that. In March 2007, national home sales in the US fell by 13% year over year compared with March 2006. The biggest drop in sales since 1989, and the average home price fell 33%. Here's an article from Investopedia just highlighting some of the things that happened in that crash. The stock market and housing crash of 2008 had its origins in the unprecedented growth of the subprime mortgage market beginning in 1999. And then at the bottom, by the fall of 2008, borrowers were defaulting on subprime mortgages in high numbers, causing turmoil in the financial markets, the collapse of the stock market, and the ensuing global recession. In the uptrending market that existed from 1999 to 2005, these mortgages were virtually risk-free. Borrowers could end up with positive equity despite their low mortgage payments because their homes had increased in value since the purchase date. If they could not afford their higher payments after the mortgage rates reset, they could just sell the homes for a profit. However, many argued that these creative mortgages were a disaster waiting to happen in the event of a housing market downturn, which would put owners in a negative equity situation and make it impossible to sell. Could be some similarities to today, except it's not a subprime, it's a low interest rate situation. But anyway, let's keep reading. And eventually, homeowners were upside down. They owed more on their mortgages than their homes were worth, and could no longer just flip their way out of the homes if they couldn't make the new higher payments. Instead, they lost their homes to foreclosure and often filed for bankruptcy in the process. The subprime meltdown was beginning to take its toll on homeowners and the real estate market. So that was kind of the general summary of the 2008 Great Recession, as they called it. The other big one was the 80s crash, and I'm going to focus more on Canada in this one, but it happened in the States also. So it was the late 80s. We had high inflation, high interest rates, and it peaked. The market peaked around 1988-89, and it declined, lost value until 1996. House prices dropped 34% in the GTA from 1989 to 1991, and they continued to decline thereafter. This was a very interesting article I found from, he's a realtor. I didn't have his name, but I'm going to put the link in the description. This is on one of the blog sites they have. I believe it's a Bosley real estate site. But he started real estate, this gentleman, I believe it's a man, in 1991, I believe, or 1990, just as the market kind of was flattening out or was in the downturn. He summarizes what he saw and what happened. And of course, I'm going to read some of it, but it's very interesting and it's very relatable to today. When dreams of domesticity became nightmares, a recollection of the 1989 Toronto housing market crash. The mid to late 1980s felt fresh and prosperous. There was low unemployment, lots of immigration, women were economically independent, and dinks, double income, no kids household, were reshaping the housing market. And as much as we see today, during this time, everyone effectively drank the Kool-Aid and believed housing prices would rise indefinitely. Never heard that before. The idea that real estate promised riches fueled a massive move into a speculative investment. Like an unwitting Ponzi scheme, the sheer number of people jumping into the market caused an artificial increase in demand that created a scarcity of product. So developers launched even more condos to meet the voracious appetite. For 4 years, everyone felt optimistic and glamorous, but in the blink of an eye, the bubble popped. By 1989, unemployment was growing, there was a decline in immigration, and with the conditions of rising inflation, at that time 4.98, right now it's 4.7, this was written in March, I believe, obviously it's higher now, it prompted the Bank of Canada to increase interest rates as high as 13% for a 5-year fixed mortgage. The federal government was highly indebted, spending substantially more money than they had raised in every year since 1970. Needing to get its own house of financial affairs in order, the government tightened its own belt with austerity measures, including funding and program cuts and fiscal budgeting. The goods and services tax was introduced in 1991. With governments cutting back on spending, the golden rays of prosperity fueled by credit cards and cheap capital tightened under a looming and inevitable recession. The enthusiasm for real estate suddenly became cloudy, tainted by an air of worry that rolled in quickly, changing collective sentiment. First-time buyers had been complaining loudly as price escalations outpaced their abilities to buy. Speculating sellers became indignant, holding out for the profits they expected. And every investor who could buy a condominium had already secured one under contract, and it was currently under construction. A moment came where all the property players found themselves stuck fighting for a space in the same sandbox, yet incapable of negotiating. Suddenly, in a matter of days and weeks rather than months, everything screeched to a halt. In 1990 and beyond, the thousands of new condominium units bought pre-constructions by investors were completed and ready for occupancy, but there weren't many renters willing to pay top dollar for a new tiny shoebox when you could rent a floor in a vintage house with a garden or terrace downtown for less. Instead, a huge swell of units was listed for sale at seemingly competitive break-even asking prices, but there were few buyers keen to buy in a gloomy climate, and the forecast was grim. Although the bubble burst in the summer of 1989, setting off alarm bells that the market had changed and the future would be different, the housing market collapse was not an instant precipitous drop, but a slow spiral, like a plug being pulled from a full bathtub. At first, you only see the level of water slowly dropping, but as it progresses, you begin to see the spiral flush forming, eventually getting bigger and louder with a sucking force. Amidst a climate of problematic inflation, rising unemployment, and the efforts of the federal and provincial governments trying to manage their own massive deficits, the economy dragged. And it goes on to say they ended up blaming the developers and the realtors for the housing crash, which is understandable. The next big one I want to bring up is the Celtic Tiger, or the '07, very closely related to the Great Recession in 2008, which started in the States. But it was different. It was a result of that, but the lead up to it was different. It was a result of foreign investment from multinational corporations, low taxes in the country, which of course invited all these multinational corporations and investment, and speculation. It peaked in 2007. It declined until 2013. and the losses of 30 to 55% depending on the city. Lastly, another big one I want to talk about was Japan. Japan, it was called the lost decade kind of after the crash, but it was part of the crash. It was fueled by low interest rates, inflation, and overvalued assets. The Bank of Japan raised interest rates to slow the bubble. They had them low. Of course, they raised them to slow the bubble, but it was too late. Real estate values fell by 60% from 1989 to 1992, and land values declined by a total of 70% up until 2001. So from 1989 to 2001, they lost 70%. Okay, so now that I'm done with the history lesson, I just wanted to summarize the key points. And again, if there's any comments, or correct me if I'm wrong, I'm trying to be as accurate as possible based on the historical data I could find. And I'm sure it's not, to the percent or to the dollar, but it is, generally accurate. And I did a lot of research trying to get these numbers as accurate as I could. So we have we have the Great Recession in 2008, the late 80s recession or housing crash, the Celtic Tiger in Ireland, and the lost decade in Japan. Okay, so let's first look at the causes. The Great Recession was interest rates, inflation, subprime lending. When I say interest rates, it went from low interest rates, and they increased the interest rates prior to the big crash. The late 80s, again, interest rate hikes, inflation, and a lot of speculation. The Celtic Tiger, it was low taxes, again, low rates, low taxes, low tax rates, foreign investment, and overbuilding. And the lost decade from Japan was interest rates from low to high, inflation, and asset overvaluation, which could be considered speculation. Years of price declines. In the Great Recession, 6 to 7 years. The late 80 recession or housing crash, slowdown, whatever you want to call it, approximately 7 years. Celtic Tiger was 6 to 7 years, and the lost decade was 12 plus years till it bottomed out. So this is how long did it take to get to the bottom. So they're not quick. These price moves, they seem, in my business, they seem quick, but they're not. These things take a long time to form. They take a long time to go down. And the losses, and these are generalized. Everyone experiences different losses, some more, some less, but generally speaking, from what I could find, about 33% average house declines in the States in 2008. In the 80s real estate downturn, it was about a 34% in the first few years in GTA, which had the majority of the losses. The Celtic Tiger, anywhere from 30 to 55%. The bigger city had closer to 55%, and the outlying areas had 30%. And the lost decade, 60 to 70%. That summarizes kind of generally what happens in these situations. And I want to apply it to today, right? Now, there was an interesting article I just read, and again, from Better Dwelling, I recommend check these guys out. They seem to tell it straight as it is, like I like. And they had their most recent article, they had one last week talking about, I think it was GTA, but Toronto suburban real estate is 76% overvalued, highest in all of Canada, and this is from Bank of Montreal. So BMO is saying Canadian real estate prices are the most overvalued in decades, but not all markets are equal. Earlier this week, we shared BMO data sharing Canadian homes were 38% overvalued. Today we're sharing a regional breakdown showing where the widest trend deviations are. Most regions are overvalued, but nowhere is even close to Greater Toronto. GTA is pretty bad. And when they talk about GTA, they're talking about like the golden horseshoe nowadays. Canadian real estate prices are now pushed to the limit, but nowhere is like Ontario. Home prices were 55.4% overvalued in Q1 2022, driving the national trend. The last time a trend deviation this large occurred, it took a whopping 15 years to complete a correction. A significant share of this froth is concentrated in and around the GTA, but first it's probably important to understand why corrections are needed. Well, you can read the articles and find that out, links in the description. I just wanted to get to this point. Corrections serve a useful purpose and can't be avoided, only delayed at a greater expense. Now, go down to the bottom here. Eventually, an economy faces one of two options. One, prices fall in real terms and the economy's health balance is restored quickly. Prices continue to disconnect through policy intervention until systemic failure. Then you're looking at a much longer downturn, often accompanied by a financial crisis. So I guess you got to ask yourself, are we option 1 or option 2? Do we have a systemic failure through policy intervention, or are we going to have a quick price correction that was needed? I think we're option 2, because the policies are low interest rates are what drove this market, like I've said previously. But yeah, let me know what you think in the comments. So what do I think? Based on what I just read and the research I've done, and you know, you can believe history repeats itself or doesn't, but we do learn from the past, or in this case, we don't learn. Human nature maybe believes it's not going to happen again, or we've learned our lessons, let's keep going. But I think by the looks of it, we have a lot of similarities and important similarities. So from what we've read, or what I've read and what I've shared, it looks like the biggest losses or price declines usually come in the first couple of years. Overall declines seem to last at least 6 to 7 years. Inflation and low interest rates are a major player in these crashes. The bigger the boom, the bigger the bust. So we've had a bigger boom, we're going to be set up for a bigger bust in my area and many other areas. Real estate value declines look like they precede stock market crashes. Every one of these, it's like the real estate prices started to slow and decline, and then the stock market crash came a year or so after. And lastly, from what we've seen from the history today, is it looks like we're setting up for a minimum of a 30% correction in Canada as a whole. Of course, locally it's going to be different, it's going to vary, but we're probably at a 30% correction, and it looks like that 30% is going to come within a year or two. Because again, the first year or two seems to be the most dramatic drops, and then it levels off, and if it does continue, it will be smaller losses after that. And it brings me back to, I did my Fibonacci retracement a few weeks ago, whatever it was, so I want to just add that, and this is a national, so of course, Ontario is going to have bigger losses than 30% if we have a national 30% loss, because some places aren't even overvalued at all, but like the prairies and whatnot. But Ontario is big. But anyway, 30% nationally brings us back, and again, this is an Ontario numbers I'm using, so I probably should have went higher, but 30% brings us back to a 688 valuation, which is right at the 61.8% Fibonacci retracement level. It's right near it, within $10,000 or so. So again, that's my prediction, or based on this. Of course, there's other ways to look at it. I just wanted to use this one because people always ask, how long will it take and how low are we going to go? And that's my thoughts on it, and that's my reasons why. Let me know what you think in the comments. I'm always happy to hear. I read all the comments. And as always, like, subscribe, share. Until next week. Next week's actually going to be a good one. We're going to have the May data. We're going to have the upcoming interest rate hike announcement. It's probably going to be a rate hike. That's on Wednesday. Lots of things happening. Ontario elections. So next week's, I'm excited for next week's video. I'm going to have a lot of things to talk about. But until then, thanks for watching, and I'll see you next time.